All right, good afternoon. Looks like it's still not working. It is? Okay. So, good afternoon, everybody. Thanks for showing up today. Just really quick, I'd like to introduce myself, Jeffrey Tower. I'm the Executive Vice President of Global Business Development and Strategy over here at ChargeAfter. To my right are three fine gentlemen. Screen's out. Joe, why don't you go ahead and introduce yourself?
Thanks, Jeffrey. Joe Ross. I'm product director at FIS, responsible for lending strategy and partnerships across both our banking and merchant base. Specifically been focused in the last year on B2B lending. How do we enable point of sale lending to our merchants, buy now, pay later to our merchants? So looking forward to the discussion today.
Thanks, Jeffrey. Jay Reinemann here. I'm a partner at Propel Venture Partners. We're an early stage fintech-focused fund. And full disclosure, we're also an investor in ChargeAfter, proud investor. Career in financial services prior to starting Propel as a lender in payments. And now spend all my time trying to understand the industry and try to back guys that are trying to change it.
Hi, I'm Sanjay Sakhrani. I'm an equity research analyst at a firm called KBW. We're a financial services and fintech investment bank based in New York. I cover companies in consumer finance and payments, and ChargeAfter and buy now, pay later sits at the cross section of both those sectors.
Excellent, thanks for that. So the first question goes out to you, Sanjay, and I do apologize for reading. There's a lot of buzz surrounding embedded finance, and as an analyst, what excites you the most about the vertical right now? And where do you see the vertical evolving into over the next, let's say, 24 to 36 months? And if I may, as a follow-up to that, how do you think the banks can best use embedded consumer finance as an opportunity for their own growth?
Sure. It's a pretty extensive question you have there, and I'm going to try to narrow it down as best as I can. I think a lot's changed during the pandemic. Obviously, the way consumers transact has evolved away from offline to online. And I think those that can be at the center of where the consumer is, meet the consumer where they're at, are going to win. So I think embedded finance is where merchants can actually leverage their relationships with their consumers, among other parties, to really help the merchant and consumers sort of lead and build a constructive path together. Where this goes over the next 24 to 36 months is a really interesting question. I think many starting points are going to be clusters of merchants and businesses that have lots of consumer relationships. They're going to try to do more. And so I believe embedded finance has a huge future. I think big tech is going to get involved in a significant way. And to answer the second part of your question, I think financial services companies are going to have to live in a world where they might get filtered. And as they get filtered, they're going to have to find ways to be relevant to the consumer. And I think some institutions are doing it better than others. I cover American Express on the research side. I think they give you a reason to want to use their card, and they make sure that merchants, they demand that merchants actually take their card, right? So I think financial institutions are going to have to find ways to make their consumers demand that their brand is utilized at wherever they transact.
All right, then the next one over here is for you, Joe. So you have the pleasure, I would say, of being the product director for lending strategy at FIS. And working on products that are used by both merchants and, of course, their shoppers. What aspects of embedded finance or the embedded finance journey do you really see as the most important today to end users, and in particular to consumer finance at the core of the embedded finance experience?
Sure, thanks. So when we talk about embedded finance and talk about lending, there's so many dimensions to it, especially where I'm working, thinking about B2B lending to those merchants, and then those merchants being able to offer buy now, pay later or point of sale lending to their customers. I mean, I think regardless of all that, what those customers are looking for is very similar. They want, lending is an enabler. It's not the end product. So, how do we support a buying journey, or how do we how do we help a small business manage its cash flow? Those are the important things, and the lending should kind of be secondary. People like to give the example of, I take an Uber ride, the payment happens behind the scenes. That's kind of the perfect embedded finance story, and how do you carry that forward into lending? I think there's a number of other ways that we should think about lending in an embedded experience. We don't just want to take the typical experience that we have today, where I go into a bank, I apply, I may get declined, fill out a long application form. It may take a week to process. Embedded journeys, people expect something different. They expect real-time decisioning. They want to see approvals. They want to get to where they're going, right? Which is making a purchase or doing the thing that they're after. I think the other thing I think about of what end users value is trust. So it's interesting, I was kind of thinking about it, where embedded finance kind of started a while ago is taking a payment. You know, no one would ever think about putting in their credit card information on a website to take a payment. Now that's you don't even think about it. You know, you scan your thumb, it automatically fills in your credit card, and it's no problem. I think when it comes to lending and other forms of embedded finance, like, you know, a deposit account, for example, there's that trust that still needs to be established. And I think it's going to be interesting to figure out where that trust lies. So if you think about taking a payment, you're not thinking about, well, WorldPay is processing my payment, so I trust that. This merchant is taking my payment, I trust that merchant, right? So is BNPL, point of sale lending, going to be more about that brand that you have an affinity to, as opposed to these peripheral brands? I mean, it's interesting to see how it'll shake out.
Jay, so as an investor, why do you think the market growth is so strong right now for embedded finance? And I would say in particular, consumer finance being embedded by banks and by financial institutions in general.
Yeah, great question. I think the last few years have been a little bit confusing, probably for everybody, just because the narrative has been that the banks are going to be dead, and that was really because the VCs gave a lot of embedded lenders a lot of money, and so I think what I'm hopeful for now is models where it's more of a technology play, where banks can be banks, merchants can be merchants, and people in the middle, even like FIS is in the middle, like enabling with technology, where instead of having a startup that has no balance sheet, has no business, really being able to compete on a lending perspective, now we at least are going to be able to have some companies that are going to be able to shine out of this, that are going to be able to survive with real business models. I think that's been hard to understand that what's going to happen until now, because now with the era of easy money really now gone, I think we'll see, unfortunately, some of those higher flying technology lenders having more problems. Raising that next debt facility is going to be hard. Their loan losses are going to be going up. So I'm bullish on the industry only because now we're going to try to put the people in the right places. The technology companies are going to play a technology role. The banks can be partners to the technology companies, and the merchants don't have to worry about it because they're also going to have technology companies.
It seems like everybody's going to have more of a focus. You know, recently a lot of the banks that we're working with have told us we want to focus on being the bank, right? And you guys do everything else, right? So it's about being the bank and it being also being able to, let's say, compete with the fintechs out there who've been able to onboard merchants very fast, you know, very rapidly. And these are technologies that the banks haven't really had up till now. So the embedded finance is another step forward for these banks to be able to go to market rapidly.
Yeah, I think the partnership model is definitely the direction they're going to need to go. Just as I've been inside of big banks. It's hard to build inside of big banks. It's hard to get the right kind of talent, to get approvals through the control groups. Whereas the advantage of the outside technology company, like a ChargeAfter, I mean, they're able to do it. They're backed by people that are looking for them to take risk, and they're the top of the game.
So Joe, what are the biggest challenges that embedded finance could help your clients, merchants, let's just say, or banks and merchants overcome?
Yeah, so I think BNPL already established that it's removing friction from the buying journey. If you can't purchase this today, you spread out the payments. It's increasing basket sizes. That's pretty obvious. Some of the other stuff we're doing on B2B lending, where I see a lot of demand for that type of service. What platforms are able to do is leverage a lot of alternative data. So if you take FIS, we have a lot of processing data on SMBs. We're able to, underwrite those customers, get them into finance products that maybe they wouldn't otherwise be able to by going into a bank and having a credit bureau pulled on them. So I think those are kind of the two big pieces that are really being solved here. I think also, we talked about merchants, we talked about banks. So we talked about merchants. Banks are benefiting by this alternative data. They're also benefiting by additional distribution channels outside of their core bank. And I think there's one other one, which is platforms, which are really looking to be able to create stickiness, add additional value-added services, grow their average revenue per user. They're very hungry to embed these types of solutions. So they're going to aggressively make this happen. And really lead the charge on transforming some of this.
Sanjay, so has COVID played a role in boosting the acceptance of embedded finance by retailers, banks, and FIs? And if so, why? Also, have you seen any major market changes or shifts in the powers of BNPL or BNPL fintechs, I would say, over to the regulated banks and FIs since COVID as part of the changing market?
As we spoke about earlier, I think there was a seismic shift during the pandemic where commerce moved online, and that was a big inhibitor or a tailwind for e-commerce and embedded finance to really prosper. I think the incumbents were a little bit caught flat-footed, right? Because they didn't really believe that buy now, pay later was going to be a big thing. And, rightfully so, it wasn't growing as fast as it was through the pandemic. So I think one of the things that we talked about earlier in a separate conversation was the incumbents were very quick to respond and provide an alternative. Now, it may not be the perfect user experience like some of the fintechs, but they do have an advantage in that they have other economics that they can tap into to help subsidize a similar product and actually use that as a source of getting new customers. So I do think there is an economic advantage that the incumbents have, and now that they've found some religion around, offering this product, you're going to see them come in and compete. And then we have to ask ourselves the question, what kind of economics do the merchants want, and how much is sort of a clearing cost for the fintechs to provide the services they did before? And I think the price points, from what I gather from some of the players in the space, is it's going higher as we're trying to figure out how they're going to survive in this post, excess liquidity environment. And so there's going to be some economic model rationalization, and I think that's going to lead to, shifting sands, and we'll see how it plays out.
So Jay, Bain in their embedded finance report recently said that the embedded finance is a $2.6 trillion market currently and has a potential to reach $7 trillion probably within the next 3 to 6 years or next 3 to 5 years. How do you personally see the market growth over the next 3 to 5 years playing out and to actually reach that $7 trillion mark?
I think, frankly, the retail e-commerce has been the first sector that's been exposed to buy now, pay later. And as we've heard, some banks are starting to play in here. I think, frankly, there's a lot more to go. I think there's some announcements that we'll probably see, maybe even during Money 2020, about more banks participating. And I think primarily either trying to do it directly or even through partners. But it takes a long, as we know in the investment world, it takes a really long time to get a bank as a customer. We expect 9 to 12 months. And so if we can finally start to see some of these big headline players sign up and make these announcements, others are going to follow, because there's a lot of money, I think, that's still on the sidelines that could benefit by playing in this market. It's a brand new distribution channel that they just haven't touched so far, and I think it's in retail e-commerce is one of the only sectors that's really been tackled, but I think there's a whole bunch of other areas that could be, and that's where we're going to get to that $7 billion. Yeah. It could be in auto. It could be in health. It could be, I mean, there's so many other places. It's got travel. There's so many more areas that probably need to be covered where a lending opportunity exists. Right now, it's just not very well covered.
So as a round robin, before we close this out, and we'll start off with you, Joe. So with new incoming regulation on BNPL, how can bank and FIs, I would say, lead embedded consumer finance and provide a better value proposition overall for both the merchants and shoppers going forward?
Yeah, I mean, it's going to be interesting to see what regulations do come in. I mean, I know the CFP's been kind of probing, and there's a lot of guesswork out there around what types of requirements that are going to have. Obviously, the more they put in, the more it benefits the banks because they have to do this as it is. You know, they get audited by the OCC. They're having to do, you know, if they want to do BNPL, they basically have to follow lending regulations. So the more that comes in, the more the economics shift in their favor because they have to bake it into their costs as it is. I think one of the benefits of banks is when you get to that white labeled experience. I mean, I'm curious to see how this plays out around customer acquisition. Like, is this always going to be a customer acquisition play for a bank or a fintech, or are they going to kind of disappear behind the scenes? And it's really more I'm creating stickiness to the merchant. But I do think that banks are in a better position to do that. Like when we look at embedded finance and launching a whole bunch of different products like a deposit account and lending and buy now pay later, people don't expect to see a whole bunch of logos all over the place. It's got to be consistent. It's got to be the platform. It's got to be the merchant. I feel like that's some of the future direction, which may be pushed forward with regulation.
I would tend to agree with everything you've basically just said. The banks are going to have an advantage here because they've been used to doing this before. They already understand the current lending laws. They're extremely conservative with how they approach the opportunity, and that's going to benefit them. So I think they're going to stay out of trouble. I think they probably still do have this disadvantage where they just may not take up a new business model or a new partnership model right away. But still, I think once we see a couple of these larger banks adopt these partnerships, I don't want to call them lemmings, but in some cases they are. They just need the comfort that others have done it in some cases.
Jay? Sorry.
So look,
Sanjay.
I just finished up a meeting with the CFPB, and we talked about this. And look, I think the positive thing is the CFPB says that there's value in buy now, pay later. And I think that's great for everyone in the ecosystem. The question is, who's good and who's bad? Who's going to be able to run this business for profitability in the future while making the adjustments they need to for their economic model to work? And I think we'll figure that out. We know that the banks have the capability of providing this at a profitable level, and they have a lot of different products that they could feed lead gen from buy now, pay later into, right? So they can graduate people from buy now, pay later into general purpose and installment lending and mortgages and all this other stuff. So, you know, I think it's critical, and I think where the buy now, pay later space is they're going to try to find a way to evolve these customers into those types of products and other ones where they might be able to be marketing companies and other stuff. So, you know, I think it's a different game. I think the bottom line is, though, as we've seen with the valuations coming down the way they have over the past 6 months or so, is the market identified the TAM as much larger from a revenue pool standpoint than it was. And I think that we're now more at a rational level. And there will be winners and losers. And that's the bottom line.
As always. Sanjay, Jay, and Joseph, or Joe, thanks a lot for joining me today. Appreciate it. Thank you, guys.